Hello there, it's Martin North from Digital Finance Analytics. Welcome to our latest show, and thanks for joining us on this Tuesday evening for our live show, where we're going to do a deep dive into some of the latest data on property and also discuss some of the broader implications, look at my modeling, and also ask some specific postcode questions too. I should say that it's just me tonight, so this is very much a deep dive on my analysis, and I think I may have overdone the the slides with Cookie's help. So, Cookie, thanks again for all the information you've been sharing. There is a lot to get through. We're going to do it in three sections. The first section will be the latest news and some of the contextual stuff. The second section is my specific analysis on the modeling. The third section is looking at particular postcodes. And I've had quite a few come in beforehand. Done a bit of work on those, particularly looking at the price trends as well, which makes it quite interesting watching. Before I go further, I should just remind you that we're not providing specific financial or legal or property advice, a general conversation only. Moderate the chat, but feel free to throw your questions, comments, suggestions as we go. If you use that Walk the World, you can get into my queue, and then I'll see your question. Hopefully I can have a chance to answer it. Or indeed, if you'd like to support us via Super Chat, you can do that too. And in fact, if you put a super chat against your question, it'll go to the top of the list, or indeed make a contribution to what we do around here more generally. Always appreciated. We don't do this for profit. We do it because we think there's a really important conversation to be had. And of course, tonight it's going to be talking very much about property, what's going on, and the gap between the spiel that's coming through the social media and through the property reporters and the portals and what's going on in real life. There's a bit of a gap, and the gap is, well, frankly, getting worse and worse. So it is a bit of a problem. And just to acknowledge, got a few people. MCM, hello, nice to see you there. Merlin, nice to see you there. Of course, the Old Faithfuls as well. So lovely to see everybody here, and we'll keep going. Now, I want to start by just sharing this particular picture. This is the latest from the ABS that came out today. And what it says is that the total value of residential dwellings in Australia rose to $11.56 billion across the quarter. The number of residential dwellings rose by 53,600. So just bear that in mind if you think about the migration. And the mean price of residential dwellings rose to $1.016 million over the quarter. So that means that the mean price across Australia is now more than $1 million. That is remarkable and disturbing. And you can see here the chart showing the value of stock rising. It did drop, of course, a few periods ago, 22, 23, but that's been rising quite steadily. You can see that the mean dwelling price, Sydney is leading the way at $1.25 million, followed by Queensland at $977,000 and the ACT at $949,000. That's a weighted average between houses and apartments. So it is pretty incredible. Billion. If I said billion, I mean trillion. Yes, $11.3 trillion. It is pretty remarkable. Yeah, the next point to make, of course, is that it's also a question of house prices versus capacity to pay. This is an oldie but a goodie from CoreLogic and the RBA. Median price continues to rise. Capacity to pay, not so much. In fact, it's going in the other direction. But if you look at the latest data from Shane Oliver, commented on the latest Melbourne Institute Westpac survey, it showed that there was a further rise in consumers' home price expectations, actually the highest since 2010. I see that in my surveys too. Perceptions of whether now is a good time to buy a dwelling did fall slightly, but is continuing to trend up, although it still remains soft, consistent with poor affordability. And I actually see that too. But I have to say, this idea that everything is bubbling and, buy, is definitely in the minds of many. Actually, I made a show about that the other day called Property Myths versus Reality as Financial Pressure Still Builds. And today, I want to talk about those financial pressures, how they're still building, and what the implications are. But as we go into that, it is worth just reflecting on this chart, because this is actually, in a way, the killer chart, insofar that it shows you what broad money is doing. Now, broad money is a way of measuring the total amount flowing around the system, and this is the percentage growth. It's 12-month ended, updated each month. And I want to highlight that over the period between 2018 to 2021, we had a significant spike up. It then dropped down. That was because of the RBA, of course, stopping their bond purchases and things like that. And now we've started to see it rise again. And so broad money is a very interesting proxy for home prices. And if, in fact, go back further, if you go back to the 1990s and the 2000s, you see there that broad money in Australia rose significantly. House prices followed. And you can also see that between the 1998 and 1990, the broad money fell significantly. That, of course, was the recession we had to have. Prices dropped. So this is actually a significant indicator. And in fact, if you want to do a bit of an overlay between home price moves and broad money with a bit of a lag, they are quite well correlated. Now, in the broad money, of course, we have government debt, now up to $1 trillion and is continuing to rise. Now, obviously, Australia could handle more debt, but it is worth recognizing that the Australian government gross debt has jumped from 5% to 37% in the last 15 years. That's compared to GDP. And it's also interesting to note that there are some significant differences with the benchmark 10-year yield at 4.3 compared with 3.4 in Canada and 1.6 in Japan. So what it means is investors are quite attracted to Australia because of the high interest rates, but also it means that governments, when they borrow big, have to pay big. And basically that's a more significant bill. So that's the first reason why we have significant liquidity and therefore M3 and broad money rises. The second is, of course, private credit. It grew again. And you can see there that in the 12 months to July, investor credit rose 6.6%, owner-occupied credit growth 5.5% on a 12-month analyzed basis. That tells you that credit is growing faster than the ability to cover it by inflation. So this is real. And as Steve Keen continues to highlight, and I want to stress again, housing is unaffordable due to supply issues. Not really. It's part of the story, but the real story is the unlimited mortgage money that the banks are being allowed to pour into housing markets worldwide. And the result is that younger generations are paying 2.5 times what baby boomers paid, inflation adjusted. And of course, you've also got the down payment question. How do you save for it too? And it is worth just reflecting on this point that when you actually understand how money is created by the banks, it's not that they have deposits and they lend it out. No, actually what they do is they can create money by lending it first, and their capacity to lend is only limited ultimately by the appetite of potential borrowers to grab the money. So this is another reason why the money supply is booming, and because money supply and because lending is growing faster than inflation, it's no surprise that house prices are continuing to rise higher. It is a basic economic fact. And I will make the point that many people in the Reserve Bank and other economists still don't get. They still don't think that somehow credit from banks is partly responsible for what's going on with house prices. But to my mind, it is, and Steve and I see eye to eye on it. All the modelling that I've done suggests that is exactly right. So that's the critical point. Now, more broadly, if you come back to the economy, just to sort of understand where we are, the data is pretty significantly showing that there was a little bit of pace. We had a bit of growth, but, there was a business investment lagging. We're continuing to see that. The real GDP is relatively low. And it's also worth remembering, of course, that the way that the RBA does it, the 0.7% growth is a sort of a proxy number that they plug out at the end of their modelling rather than putting it as an input. Very importantly, incomes are not likely to recover until 2037. And if the Reserve Bank is right that our productivity growth is only going to be something like 0.7% a year, then we won't be able to see any real improvement in real terms until 2037. Now, of course, they're still borrowing big. The government is now examining changes to the tax system, looking perhaps to reduce unnecessary regulation. Well, we'll see about that. But as Ted O'Brien says, living standards in Australia can only grow if productivity can be returned to a more sustainable level. And of course, the recent discussions in the round table around productivity didn't really add much to the debate. Now, of course, Chalmers is on one hand having a debate about intergenerational unfairness and claiming that it's the older people that have done it. And one of the reasons why he's perhaps wanting to try and tax assets. On the other hand, things like the super reform, it's getting a bit mired at the moment. And I think it's a good thing because this idea of taxing unrealized gains is unprecedented and very concerning. But I don't believe we're seeing much really good policy coming out of government at the moment. And they do seem to be wanting to continue to borrow big, despite what they say, which means that, of course, the debt gets bigger. And what that means is that we need more taxes. Taxing, of course, is at a very high level at the moment. All the bans are frozen. And what we're seeing, of course, is now the government scrabbling around for other ways to try and get more money to come into the hopper through the tax system. And we'll see how that plays out. The next budget will be quite interesting, I think. Now, the other lever in all of this, and the conundrum is migration. Migration, of course, increases the pie. In theory, one of the reasons migration is quite strong. But of course, migration is not without its problems. And of course, this report here makes the point that 49% of people now think that immigration in Australia is too high, up from where it was previously. Now, I'm not anti-migrant, really, but I am saying we need to right-size it for the economy at the moment, and that's the problem. And this article here, as I've quoted a couple of times, but it's worth just reviewing, a nasty collision of hate and housing. If you've got strong migration and if you've got people who can't effectively get a property because of too much demand, not surprising that you have contention. Not surprising that people then say, well, hang on a moment, is this right? Now, of course, on the other hand, Paul Scully in New South Wales says, well, we need more people because otherwise we're not going to actually have people living in Sydney. They'll be there without their grandchildren, et cetera, et cetera. And of course, we need to increase development. But, the supply side is not the problem, really. The demand side is the problem. Credit is the problem. And I discussed this all with Tarek the other day. If you check out our earlier show, is Australia approaching terminal decline? And we concluded that, well, unless things change, it's hard to see how things don't go down the plug hole. Now, as I discussed earlier in the week, migration is a significant issue. It's interesting that David Pollock here, the senator for the ACT, wrote an interesting opinion piece in the Financial Review suggesting that Labor must buy into the debate on immigration and population rather than just being a bystander, looking for more active leadership. There is no net overseas migration target, and over the past few years, the Treasury forecast has been short of somewhere between 40 and 80,000 what actually happened. Inaccurate figures, lack of cohesion for population, lack of political leadership, and of course we need sufficient housing and other infrastructure for new arrivals. Absolutely. But the point really is, can we handle this given everything else that we've got? Now, of course, the other thing that's going on at the moment is this reshaping of the inner cities, residents opposed to New South Wales. Very interesting here that 10,000 new homes around Woollahra. The YIMBY tendency, it's all of this same stuff here. And it's interesting, did you see this from CoreLogic? They published a report looking at the Phase 1 and Phase 2 Sydney Metro line expansion and showing the areas within 1K and the 1 to 5K away, where effectively the idea is that more growth, more momentum will happen. And it's interesting, though, they also said that the price growth in those areas wasn't as strong as others across the Greater Sydney benchmark, which I thought was quite interesting, partly because of stretched affordability, reduced borrowing capacity, the higher price points within Sydney metro catchments are likely to limit growth, which I thought was very interesting. And Vanessa, may I just acknowledge the super chat that you've made there. Really, thank you very much. Thank you. Thank you so much. And yeah, really enjoy putting the charts together. It helps to tell the story, doesn't it? So thank you very much for your support. Really appreciate it. Now, just to sort of develop this argument a bit further, I thought this was an interesting one. Did you see this? 12 Mossman owners sell for mega unit block. So this is people in Rangers Avenue in Mossman, an area I know very well, got together and they've decided to sell their property for a $750 million apartment building with 8 stories. They can get 8 stories as long as 15% of the apartments are at 30% below market rates. So there you go. This sort of Macquarie Mossman is looking at a particular change in going forward from low rise to high rise. And of course, this is part of New South Wales government commitment to build 377,000 homes across the state. Mossman has delivered just 10 new homes annually for the past 5 years based on government figures. And the 29 apartment development received 90 opposing submissions to Mossman Council last month. So it is very interesting that there's this furphy now in these more affluent areas. And it's interesting that Mossman real estate agents are busy working to put together more amalgamated site deals in the neighbourhood. Just on lending, I will make the point that Macquarie is leading the way in terms of growth. Funny about that. And of course, we've also got the story of Melbourne. Now, according to some, Melbourne was beaten down, but now a buy for investors. I'm less convinced, but we did see a massive exodus of private investors post-COVID, especially because of the surge in the land tax. And we're still seeing more property investors in Melbourne listing their properties and wanting to get out because of negative returns. So we need to be a little bit careful about some of the BS that is being reported in the papers. Just on that, I also highlight the build to rent. I saw a comment earlier on about the build to rent story too. It is a very significant story. It's a very concerning story. And one of the points I want to make is that the whole idea of build to rent is a problem. They won't be building that many affordable properties. A lot of them will be more high rise, and of course will be attracting probably people who can afford to pay a lot more. And yet they are being absolutely paid from the tax breaks to come and do it. So no surprise, we are seeing more of those. And as Cookie Boy said, yeah, wonder about the build quality as well. Well, I wonder whether the build quality in Mossman will actually be good or not, or whether they'll cut corners there too. Look, build quality is a real problem. I report this on a regular basis with Edwin, and we are seeing this. And the other interesting question I will pose is, will these build to rent buildings be much better too, or will they be just thrown up, bearing in mind it's very hard to get people to build anything at the moment? Now, the summation of all of this is on the supply-demand discussion. On the demand side, migration is a big question, as we keep coming back to, and we'll come back to it again. On the supply side, it's worth just highlighting this. The 1.2 million new homes will it help affordability to fade away? Probably not. Interesting question, but building 1.2 requires people to build, and the Master Builders Association is suggesting that that's going to be quite difficult. How are they going to reach the targets? Going to be very hard to do. Vying the first suburbs without children and grandchildren, of course, is the old thing they keep talking about. And just to add insult to injury, just let's show you this one. The government has frozen the construction code, of course, until 2029, trying to fast-track housing approvals. But look at this. The dwelling approvals is well below where it needs to be to reach their targeting accord. And I would make the point that the chances of reaching the target is quite low. But the other point is the mix of property in these dog boxes that are being pushed very hard means that they might actually get towards the target, but nevertheless, even if they do, the quality of the construction will be poor, and it'll be squashed together, and it will change suburbs across the place significantly. And a lot of people in my surveys don't really want to live in those things. They would prefer to live in low rise, whether it's just houses or whether it's low rise apartments in low density areas. But no, we're being corralled into high density. And of course, some people say, 50-minute cities and all of that jazz, which is part of the story. Now, as I reported earlier in the week, of course, the media is still pushing hard the idea of high auction clearance rates. With an initial cess rate of 75%, it was the fourth straight week that the preliminary clearance rate across the nation's capital hit the mark, according to Catality. But as I just remind everybody, number sold versus number reported versus number listed, it ain't the same. And when you actually realize that they report the number reported compared with number sold to make their magic number up, you can see that this is really not a very good indicator. And in the earlier show, I went through some of the other articles to show just how much spruiking there's been around the place. What I do think is true is this article here, that clearly there is a battle between first-time buyers and investors, and property investors are actually winning at the moment, particularly as interest rates are coming down because they can afford to borrow more. And I think that's a very significant issue. And it's interesting that the new owner of Domain went and sort of watched the auctions running, and he was amazed at the real drama there and the tears when investors outbid owner-occupiers. And of course, yes, the selling season is going into overdrive. Well, maybe not. And the point I want to make is we've got this massive disconnect between what people are saying is going on and what is actually going on. And I just scratch my head thinking, well, why? Why is it? Why is it that we've got this gap? Now, of course, we've got government incentives. We've got the first home buyer scheme, which will allow people to buy with a 5% deposit. That's going to start up in October. I'm going to run some special shows on that because I think that's a really bad move. And as Nicola Powell, also from Domain, said, investors are coming back, they're chasing capital growth, etc., etc. So there is a bunch of reasons why prices may well be rising, but when you look closely, it's not as simple as that. And my argument is that the chances are we're not going to be able to solve this. And the ANZ chief economist said this is a 40-year-old housing affordability problem. We're not going to solve it with just a small bit of building. And by the way, if you think the rates are going to get cut, well, maybe not. The Reserve Bank may be cautious, according to Shane Wright. Rate cuts fall as economy expands. And again, the party might be over for future rate cuts as we go on to a spending spree. ANZ's latest economic forecasts are not good news for frustrated households. There is a chance that we won't see any rate cuts. So, where are we? Well, it is quite complicated and difficult, of course, but the bottom line is I'm not sure that the RBA really has their finger on the pulse here. And in fact, there was this article quite recently that came in and said, well, maybe they don't know much about property prices, and maybe they're actually wanting to walk away from part of the conundrum. It goes back to what I said earlier on about the fact that you've got this issue with lending being the priming of the pump that creates the liquidity that allows banks to lend more, that pushes prices higher. All of that's going on. But it does lead you to a very important question. I covered it in the other day in a post. Is there a confident or constrained consumer? The answer is a bit of both. There are some who are doing very well, but there are others who are not. And depending on where you are and who you are, you'll be feeling quite different about things. And if you want to, really know the truth, this chart, I think, really is a very important one, just underscoring that Aussie renters will continue to see rents rising over time. This is from CBRE, and they're suggesting that the weekly rent for a two-bed apartment will continue to rise. And today it's, 450, 500, 600, but, in 2029 it'll be 900. That's because we don't have the policies aligned. We have the supply-demand disequilibrium. We have a government that's focusing on the supply side when we don't think they can deal with it. And on the demand side, of course, with all of these additional incentives, first-time buyer incentives, and everything else, not surprising that we've got this massive crunch going on. So there you go. That's sort of the first part of the story. Alison, hello. Nice to see you in the chat there. Thank you very much for dropping in. And I will make the point that Globetrotter is also talking about the fact that agents are involved in inflating prices. They are indeed. If you go back to Edwin's conversations, as down under it also says that we've got the crappy bills. Yeah, so we've got crappy bills, we've got the real estate agents playing, and all of that is flowing into the problem. So let's move into the second part, which is just a little bit of an overview of my modeling. And of course, for those who've seen it before, this is not new, but just those who may not, this is actually how I do my research. I take data from my surveys. It's a rolling survey, 50,000 households. We model it monthly. And we slice and dice the data to be able to look at it different ways. And that allows us then to think about what may be happening and take a view of what may be happening ahead through our scenarios. And we can take our data, the stress data, the trajectory data of prices, the selling and buying intentions, migration data, the economic data through the core market model, and we can analyze data at a region, a state, or a all state level, and also to postcode level. And of course, today we'll be looking at postcodes as well, and giving us the view as what may happen ahead. Now, just a quick advert, if I may. We do provide a one-to-one service. So if you're interested in having a deep dive on a particular suburb, we can do that with an individual conversation. I can't give specific financial advice, but I can talk about my data and look it down at postcode or suburb level and look at the underlying trends. I can look at stress, home price trend data, and look at the modeling ahead based on what I'm seeing. And if you want a conversation, about an hour normally by Zoom or phone, you can book for that. There's cost involved, unfortunately, because it takes quite a lot of time, 7 to 8 hours of research to do all the work. I make a few phone calls, talk to the agents as well. And if you're interested, book via the blog. 3 to 5 weeks ahead is what I'm booking at the moment. Let's talk about stress now. I get a lot of comments about this sort of made-up definition of stress that I've got. Well, it isn't really that made up. It's simply saying, think of it like a business, money in, money out. If more money is going out than money coming in, you've got a problem. That's basically what I'm saying. And that's how I measure stress. So it's basically looking at the difference between the money coming in, the money going out. I don't look at underwriting metrics for my stress. I don't look at just 30% of income like many other people do. But I do find that this is a really powerful way of looking at the problem. And that means that if households have more outgoings than income, then we define them as stress. I exclude one-off discretionary items like going for a holiday, for example. If they have a mortgage, they're in mortgage stress. If renting, they're in rental stress. And investors have a cash flow pressure that we identify them as stressed investors, and we can roll it up to the total financial stress, and we can look at it both at a percentage and a count basis. Because of the fact that I'm interested in the large data points, the count is actually quite powerful, and I focus in on that quite often. Now, the RBA chart that I keep trotting out is a very important chart. It makes the point that budget pressures start from a mild stress perspective. Over time, can miss payments and then go into insolvency. That journey can be 3 to 5 years. I'm measuring stress at the early end, the budget pressure end, the mild financial stress end. And what I'm seeing is that over time, people actually can pull themselves out of stress sometimes, but in others, they actually fall over. Ultimately, although the banks might prop them up for a bit, they might refinance, they might actually get some help in other ways. But what I'm seeing, unfortunately, is that as people get into more difficulty, they tend to grab more debt, and that more debt adds to the pain and the problem. And then you see buy now, pay later, and you see all sorts of other things going on. So the budget pressures are real. And that's the point I want to make, that we are in a situation where we've got house prices still looking to go higher in some areas. We've got the cash flow pressures on households because inflation is still rising quite strongly. Real incomes aren't real income growth when you actually look at it, and you've got budget pressures there. So when you pull that together, what do you get? Well, this is the information to August 2025. And I look at, first of all, rental stress, because it's the most significant. I think rental stress is not reported significantly in the papers. And to me, this is a really bad problem we have. About 3/4 of people in the rental sector have cash flow pressures. So they're still paying their rents, but they're struggling to do so. They're cutting back on other expenditure to do so. For those in the mortgage sector, we've got about 51.1% in mortgage stress. So over half. It moved up from 49% last time. But if you compare it with Fed 2020, it was 32.9%. So it's going up and it's staying high. Why is it staying high? Well, it's staying high because we have this pressure on households because of the cost of living still rising faster than CPI. Wages growth is not necessarily as strong as it was. Also, we're seeing some people now not getting the hours they wanted. They might be working multiple jobs, but they're not getting the hours they wanted. All of that thing is working through too. And so we're seeing more people caught in this dilemma. Whether they're renting, whether they've got a mortgage, their cash flow is still under pressure. And we'll look at some details on that shortly. And just to remind you, there is still this issue with regard to the debt to income ratio. It's still very high. Now, the RBA reports it in a particular way because they count it across all households rather than those with a mortgage. If you were to actually recalculate it, it's close to 6 times. And in fact, a lot of new households are still getting mortgaged at 7, 8, 9 times their joint income. And just to reinforce that, when I say joint income, go back a couple of decades, it used to be one income plus a bit of a second income, and that would still be enough to be able to get most properties with a relatively affordable mortgage. Now, 2 full incomes still doesn't get you very much, still doesn't get you accessible to the majority of property, particularly in the major centres, and yet you've got 50% of your income now servicing the mortgage. So that shows you just how far we've come in the wrong direction and why it is that we've got this massive problem with regard to households and their finances. Now, when you actually look at the data in detail, and just quickly, I'll go through this again in case you didn't see my other show where I went through the high-level results. You can see there that in yellow, mortgage stress rose in pretty much every state other than the NT and South Australia this time. It was higher overall at 51.1%. That's 1.9 million households across the country. Rental stress was up in some places, but it was down in New South Wales, down in South Australia, and down in Victoria, just slightly down, and therefore down overall, but still 2.3 million households in the rental sector having difficulty. And just to bear in mind, we've got about 10 million households across Australia at the moment. Stressed investors doing a bit better because the interest rates are being cut. And as interest rates are being cut, they are finding it a little bit easier. But on the other hand, costs of managing the property and maintaining the property are still going up. And overall financial stress was higher, overall at 47.6%. That was 4.7 million households. And in fact, if you look at it, other than the Northern Territory and in South Australia, financial stress overall was higher across the month. Now, people may find that surprising insofar again that, well, so surely interest rates are coming down and surely income's going up, according to the government, so it should be working in our favour. Well, it probably would be. It stops it going high, but it's not actually bringing it back down at the moment. And unfortunately, in most states, we have a lot of people in quite a lot of difficulty at the moment. Now, that doesn't mean they're going to fall over tomorrow. But what it does mean is that they're having to make hard decisions about where they spend their money. Do they get that medical treatment that they needed? Do they eat good food or do they eat cheaper food? All the things that they have to do, they have to make prioritizing decisions. One of the ones I keep coming up against is school fees. Do I still pay the fees to the private schools or do I actually go the other way? And of course, something else which is there is all these subscriptions to the streaming media services and mobile phone plans and those sorts of things. So it's quite interesting when you talk to people in the surveys, what is essential versus what is not has moved over the years. So we've got more essential stuff. For many people, essential would mean a couple of streaming services. Well, debatable, I guess, but we are interesting. So it is fascinating to see this playing out at the moment. And another way of looking at it is actually to look at it through the segmentation or the cohorts. And when you do that, you can see, as always, it's the young growing families who have the mortgage stress center of gravity. Those are first-time buyers, of course, in that segment, 90.1%. And that's 292,000 people in this segment in mortgage stress. Looking at the rental stress, it's quite widely spread, of course. Though, again, first-generation Australians, those migrants, when they come into Australia, they quite easily and slip into rental stress quite early, 84.8%. That's about 198,000 there. And then from an investor perspective, those with more investment properties like exclusive professionals and young growing families are the ones, young affluents are the ones that actually have the highest proportion of mortgage stress from the investment perspective, simply because they've got multiple properties. And overall, you can see that pretty much all cohorts are touched by this problem, some more than others, but young growing families at 68.4% are leading the way. And overall, that means 500,000 households across the country, including a lot of first-time buyers, have a real issue. What we can then do is quickly look at the mortgage stress across the individual postcodes. Liverpool's at the top there, 2170, then Toowoomba, 4350, then Campbelltown in New South Wales, Wanneroo in Western Australia, Narra Warren, Berwick, Pakenham in the areas around Victoria. These are the sort of the high growth corridors, of course. Regional areas like Ballarat in Victoria, and then we've got more places like Riverstone, Sydenham in Victoria, Tarnit in Victoria, Camden in New South Wales, Derwent in Victoria. And the high growth corridors, newly built properties, a lot of build off the plan, it's all there. Cookie Boy says, thanks for putting up the clicks for the beautiful people. Well, Cookie, thanks for making the clips available. It really is appreciated. Now, Toowoomba is way overpriced, Alison. Absolutely, Toowoomba is horribly overpriced. And it's interesting when you look at Toowoomba, 81.4%, Campbelltown, 100%. Now, these are, rough indications. My point is there are a lot of people caught in this particular area in the mortgage belt. Looking at the rental belt, looking at risk of default, I will just do that before I go on. You can see here Cranbourne, Mandurah, Armadale, Roxburgh Park, Success, Tarnit, Bundaberg, Beckenham, Derwent, Toowoomba, Wanneroo and Gosford are all areas where the risk of default over the next 12 months are significant. I've sorted it by the number. Still not massive percentage, but enough to be concerning. And again, it is fascinating to see how this issue of default and mortgage stress follow on from each other, but there is a lag, 4 to 5 years. Okay, now that's an interesting one from Robbie. Let's put that up. Hey, Robbie, nice to see you in there. I'm going to talk about our earlier conversation shortly. Robbie asked, have you ever polled people about which percentage of families would prefer one parent to stay at home to look after the kids instead of using daycare if housing was affordable? I did some work on that about 2 years ago, and there was quite a lot of people who said, in theory, I'd love to do it, but in practice, it's impossible because if I only had one income, no way could I afford to be able to get a property. No way could I actually find anywhere to live. So it is a necessity. And look, what I think is wired into the assumption of politicians now is that both parties in a family will go out to work. And of course, the childcare costs are massive, which is an interesting conundrum for many people, but trying to trade off childcare versus going out to work is a problem. What I would say is that when you actually look at the applications for mortgages, I quite often look at individual mortgages through some of the work I do. Almost exclusively now we see 2 sets of income or more income than that flowing in. So yeah, it's a real social structural issue. If I go on then and look at the rental stress, rental stress is Melbourne, centre of Melbourne. It's the hotspot. 15,000 households in Melbourne with difficulty. And the story, of course, is that it's not great. In fact, Fraser Samuel asks, is investors, they're still selling in Melbourne. Is the rental environment in Victoria awful? Yes. I think it's a no-go zone, absolutely, particularly for apartments, exactly. And if you look in the centre of the city, it's a hotspot there. Look at Docklands as well. It's pretty much wherever you look. Toowoomba in Queensland, Liverpool in New South Wales, Tarnit in Victoria, Southport in Queensland, Campbelltown in New South Wales, Zetland in New South Wales, Westmead in New South Wales, Coomera in Queensland, Ipswich in Queensland, Mount Druitt in New South Wales, Derrimont in Victoria, and Yatala in Queensland is where we see the hotspots. Comment here, 40-year mortgages, yes. Longer term mortgages. If you look at the average duration of mortgage today, it's a good 10 years longer than it used to be. Go back 10 years. And quite often when people refinance, they extend the length of the mortgage to try and help as well. I talk about subscription housing, right? You will never actually pay it off. You will always be subscribing to find somewhere to live, whether you're in rent or whether you're actually in mortgage. That is the structure that the finance sector want. They want you to pay because you're the product. Just keep paying, keep paying, keep paying. Never mind what it does to the rest of the housing finances. Cookie Boy says, yeah, we should do some more anti-spooks in Melbourne. Yeah, I did one some time ago, as you know, and we do some more. It shows you that prices are still falling. And it's also quite interesting. You'll see some of the debates there about the child care and the amount of support that's there. What we're seeing is that the governments are trying to provide some support for child care, but when you do the math, it doesn't necessarily always work that well. Okay, just going down my list, stressed investors. So here we've got a small account, of course, but you can see places like New South Wales, Lane Cove and Narrabeen, Toowoomba again, Tasmania, Riverside, Randwick in New South Wales, Westmead in New South Wales, Campbelltown, New South Wales, Hornsby, Craignish in Queensland, Beaumont Hills in New South Wales, Dee Why in New South Wales, Queensland, Southport again, Cranbourne in Victoria. So you can see here that we've got a lot of stressed investors in a lot of places that are actually there. And I'll highlight the fact that Cranbourne is sitting there down off the list. If I was to run the next few, Victoria would be much more on the list. But the pressure at the moment for stressed investors is in and around New South Wales quite significantly. And Fraser, that's a lovely little comment. I must put that up. Thank you for that. I recall I rang a mortgage broker and he was shocked when I had zero debt apart from $200 on a credit card. Yeah, I know. Debt has become institutionalized, right? And this is one of the things that I want to come back to again and again. There is a basic philosophical view about debt. And a lot of young people say, I have to take debt when I get my HEX debt, and debt is going to be with me for the whole of my life. That's what they want you to believe. The they there is the financial system. The financial system wants to keep you in debt from beginning to end, from soup to nuts. And the bigger debt, the better. Now, they'll write a lot of that debt off over time because, of course, some people fall over. But if they're making enough and they're making massive profits, they can afford to write it off. And they just want you to continue to be in debt. Now, I've always argued that getting out of debt is the best thing that you can do for your finances. And a lot of people say, no, never do that. Well, some people say I'm going to take my debt to the grave. Well, maybe, but I would argue that actually that's a bit of an issue. Remember that the longer the term of the mortgage, the bigger the interest payments that you make over the mortgage time. So it is pretty much part of the same problem. It's all baked into the plan. And I'm afraid I believe that it's deliberate. I believe that it is deliberately set up. And all of this idea is we want people who are dependent on the banks, dependent on paying the debt. That means you've got to go out to work. You go out to work to pay the debt, to go out to work to pay the debt. That is the way that it works at the moment. Now, just going back to my slides here, this is the overall financial stress slide, and it's worth showing that Toowoomba wins the prize this month with the most financial stress, 60.1%. 28,000 households out of 48,000 have financial stress in Toowoomba in Queensland. Then Liverpool, then Campbelltown, then Tarneit in Victoria, Derrimut, then Ipswich out to west of Brisbane, then Melbourne itself, then Cranbourne, Ballarat, Mount Druitt, Roxburgh Park, Westmead, and so it goes on. So they're my top places this time around. And it shows you that, this is not necessarily equally spread across all places. The maps, and we may do, if we've got time, we'll do heat maps, but we probably haven't tonight. But I've done heat maps and I can show you where those stress levels are. And of course, that puts a lot of pressure in those areas. But if you then do some mapping and map those stress areas to crime rates, what you discover is crime rates are rising much faster in these stressed areas. So there is a direct correlation between the stress levels and the issues relating to society, family violence, and all those things, as well as other types of crime. And it's interesting to note the rising crime in Victoria is quite significant. Now, I need to move on and talk a little bit about the scenarios. Now, of course, my scenarios are ways of exploring different futures. They're not predictions, they're sensitivities. And they show you effectively how this all can have an impact on what may happen ahead. They're running forward from today, and I have three. The Goldilocks zone, where we get further rate cuts to around 3.35%. We see inflation easing. We see wages rising faster than inflation. We don't get a recession, but migration strain stays above average. That's the sort of the Goldilocks zone, the best case. Then we have the base case where we have a bit of a softer landing, rates around 3.6% until December. Inflation falls, but then rises again, and we're starting to see that now actually, and it stays above target until 2026. We don't get a recession, migration falls to average, and the worst case, a nightmare scenario where we see rates sticking around 3.6%. Inflation steps up, unemployment rises, wages growth stalls due to some of the second order impacts to do with trade, and that leads to a recession in Australia. We do get rate cuts later, but it's a bit all too late. Migration drops below average. So those are the three I use. We can make up other scenarios, and if you've got another one you'd like me to look at, I'm very happy to take that and run it through the model. Each of these elements sensitize the model and give different results. And just to give you a bit of a flavour, if you were to look at the Australian house price scenario overall, best case, houses are still looked to rise 13% over the next 3 years. That's if everything goes well and we get more rate cuts, etc. On the other hand, if we don't, the base case is a pretty much sideways move for houses and a bit of a fall if things go badly wrong, about 21% down. Units, they tend to follow on, but maybe move a little less. And you can see there that units, if they were to fall, wouldn't fall quite as much. Which takes us quite nicely on to my data. Now, of course, each time I run my core market model, and this is the standard Wollongong presentation slide, which I always use because it's just the area that I know really well. And just to remind you that on this particular slide, we look at the household count, we look at the percentage who are borrowing, renting, and owning outright. We look at the mortgage stress data. We look at the mix of property, how units versus houses, versus other types of property. We look at the people ratio, in other words, how many people per average residence. And we look at the vacancy rate. Now, that's based on the earlier census. It's getting less relevant now, but it's the best data we've got. The base census was 2021. We also look at the gross investment yield, which is the combination of the price of a property versus the average theoretical total rent you could get. And then also we have the net investment yield, which is the difference between the money going out and the money coming in as an investor on average. Here it's negative. We'll look at the taxable income, both from the ATO, that's from the tax year 22-23, and also from the original census from 2021. Gives us a calculation to calculate the disposable monthly income. And from there, we can then look at what percentage, here 40% going on the typical mortgage, $2,467 a month on average, and 32% going on the typical rent. So that is the way the model works. And of course, in my earlier show, what I did was to suggest that people might like to throw up some ideas of particular postcodes they would like to look at. And guess what? I had quite a few people who actually did that. So what I can do is to go through some of those and look at some of the data that we've got here and see whether we can walk through this together. Let me just get this sorted out. Okay, so the first one I want to look at is, let's go there. Just need to set this up so I can see it. Okay, so the first one is from Raphael, and he asked for postcode 2620, and also Canberra. Well, I can't do the whole of Canberra, but I have done a Canberra position as well. So let's start with postcode 2620. And if we bang that into the model, and if we then cut across to the model, okay, so this is 2620, which is Gundaroo in the South Coast. And here we have 18,000 households, 25% own outright, 44% are borrowing, 30% are renting, half are in mortgage stress, roughly half are in rental stress too. And you can see there that houses are at 67% of properties. We have some units and some other types of property there. People ratio is sort of families, it's 2+. Vacancy rate was 7%. The gross investment yield was 3.3. Net investment yield was minus, so they're losing money, minus 2.1%. Average taxable, 96,000. I've also got the census data, 113, and you can see the multi-flag is coming up. That suggests that more than one income is going to pay the mortgage. Disposal monthly around $7,000, with 36% going to typical mortgage, $2,600, and typical rent 23.6% at $1,694 a month. Looking at the scenarios, well, the best case scenario, there's a rise over the next 3 years for houses. Base case, a bit of a fall, and worst case, a more significant fall. Units tending to follow on. So that's the first part of the story. But we can also look at the other part of the story, and that relates specifically to the price trend data. So if I switch back to this chart here, this is the price trend data for this particular postcode. This is for houses. And you can see that in 2016, the median price was $745,000. It rose in 2017, 2020, 2022 with a massive rise of more than 40%. And there was a rise in 2024, but there was a fall in 2018, 19, 21, 23, and a fall so far this year, a small one, but it's still up to $1.24 million. Now, I also looked at another postcode, Curtin, which was postcode 2605, because that was a Canberra postcode. So if I go back to my model, and I'll just put the data in for Curtin, and if I switch back, right. So this is the example from Canberra. 4,700 households here, 38% own outright, 35% borrowing, 25% of renting. We've got a level of mortgage stress that's not that high, but rental stress is very high, 88%. Mostly houses. We've got a people ratio, again, quite high, so it's families here. Vacancy ratio is just over 6. Gross investment yield is 4.2, but net investment yield is still negative, minus 0.4%. And you can see here that the average taxable, 139,000. Household was 150,000, so again, multiple incomes going on the typical mortgage. Disposal monthly, $9,400, with 33% going on typical mortgage of just over $3,180 a month, and 25.8% at $2,441 going on the typical rent. Price moves, not that flash, 7% over 3 years, best case. The base case, a fall of about 7%, and the worst case, a fall of 27%. Now, we can also then look at the price moves in Curtin. And if we do that, you can see there that in August 2016, $839,000. There was a rise in 2018, a massive rise in 2021, a quite big rise in 2020, 2022, a fall in 2023, a rise in 2024, and a small fall in 2025. And you can see there that the Curtin median is now 1.35 million, compared with 839,000 a decade ago. So the first observation is it's not doubled. So everybody's saying prices double every 10 years religiously. No, not proven here. So there you go. That's the Curtin story. Now, I also had a request for postcode 3160 from Pip. So if we look at that, 3160, let's put it in my model first. Now this is Belgrave in Melbourne. And here you can see that we've got 3,400 households in the postcode. We've got 32% owning outright, 58% of borrowing, very high borrowing level there, and renting just 9.5%. And you can see that stress is extremely high. I think it's correlated with this very high borrowing. This is probably one of those growth areas that I spoke about earlier on. It's mostly houses, of course. And you can see there that the people ratio is much higher. It's, again, families. The vacancy rate's a little lower. You can see there that the gross investment yield is 3.6. The negative investment yield is minus 0.7. I'm afraid a lot of Melbourne investment property is underwater. Average taxable 91,000 compared with 113,000. The multi-flag is up. Again, multiple incomes paying the mortgage, giving a disposal month around $7,300, with 30% going on the mortgage at $2,222 and 25% at $1,873 going on the typical rent. And you can see here that I can't see much potential for price rises, even in the best case scenario in this particular postcode. And if things go pear-shaped, then prices will fall quite significantly. Now, if I then compare that with the price movements in 3160 and switch back, 3160, you can see here that, well, in August 2016, it was $505,000. There was a massive rise in 2017 and 2021, a small rise in 2024, and then you can see falls in 2019, 2020, 2023, and 2025. And in fact, compared with last year, prices are continuing to slide, and the average is now 866,000. This is houses, of course, in this particular postcode. So it shows you that prices don't necessarily continue to rise linearly. And I'll just remind you that this massive surge up here is to do in 2021 with the massive amount of liquidity that was thrown into the market by the Reserve Bank, by the government, by the home schemes, the whole lot, the whole kitchen sink. You can see it there in that manifest rise. But since then, things have just not gone particularly well in this particular area, and prices are going sideways at the moment. Object lesson for us all. Okay, the next one I want to do is for Paul. He asked for postcode 7216. And just to say, I'm going to go through the ones I was asked for beforehand. If there's time, I'll then answer some of the other queries. I see there's a few people throwing them in the post in the request here, but I'll deal with these first. So let me go back to this particular one, postcode 7216. I'll just put the information in, 7216, and cut across so that we can see it. Now, I would make the point this is a low count. This is St Helens in Tasmania. When it's a low count, we'll be a bit careful because the statistical relevance may be a little bit watered down. A lot of people own outright, of course, here. We also have got people who are borrowing and people renting. Mortgage stress is relatively high at 66%. Rental stress is even higher, 80%. 88% of houses. People ratio is a lot lower, so a lot of individuals and maybe couples rather than families in this area. High vacancy rate. Now, of course, this was around the time of COVID, but it's also second home territory, a lot of Airbnb and all those sorts of things, so that's part of the story. Gross investment yield is positive, 4.8. Net investment yield is positive at 2.6%. Now, I see this quite a lot across Tasmania. Investments are doing quite a lot better than, for example, across in Victoria. Looking at the income, 68,000 compared with 44,000, based on the information that we're seeing there. And so we don't get the same multi because, of course, the average taxable is higher relative to the census data. But the monthly income is relatively low, and we're seeing 40% going on typical mortgage, 1300, and 38%, 1221 going on the typical rent. And looking at the scenarios, well, not much really happening with regard to property rises in the best case scenario and more falls in the worst case scenarios. And if I then go back to look at the trends in terms of prices in this particular area, it's quite interesting. You can see there that in August 2016, the median price was $206,000. There were significant rises through 17, 18, 19, 20, 21, and 22. And then the wheels fell off, and we saw a fall in 23, a fall in 24, and a slight rise in 25, but still not offsetting for 2024. And you can see there that 558,000 is the median price for houses in this particular postcode. And you could argue that here again we saw the same massive injection of liquidity Prior to that, there was very strong interest in Tasmania, and so a lot of people bought in Tasmania, so that explains those. This is a very different story now, and Tasmania is definitely on the ropes with regard to property. Mortgage stress is high, property price growth is pretty limited, and as I showed, my expectation is that price growth will be pretty flat ahead. Okay, the next one to look at is postcode 5290 from Icy Clowns. And so let me put that in the model. So this is Mount Gambier in South Australia, and I cut across to it so you can see it. You'll see there are 11,000 households with 31% owning outright, 35% borrowing, 33% renting. You can see there that the mortgage stress is at 34% and the rental stress is at 52%. 76% of houses. We've got a people ratio of just 2. Vacancy rates around 9. We've got a 4% gross investment yield, a negative investment yield of minus 0.3. Taxable was 73,000 compared with 62,000 from the census, giving a disposal monthly around $4,400 with 29% going on typical mortgage, 1300, and 24% going on the typical rent, 1096. Scenarios are best case, still significant rises ahead, base case, a small rise, and the worst case, a bit of a fall. And switching back to the other picture, if we then look at the price trends, you can see there in August 2016 it was 224,000, and we saw quite significant rises really, particularly in 2019, 20, 21, 22, 23, 24, and 25. So this is an example where prices have indeed doubled in 10 years. So there you go. You can find examples where they have. $515,000 at the moment, and last year prices were up over 10%, the previous year about 7 or 8%, and the previous year above 10%, and in 2022 up 25%. Again, down to the liquidity and significant demand in this particular location. David asked for postcode 4868, so we'll put that one in the model. So this is Warree in the far north of Queensland. And you can see there that 8,700 households, 28% owning outright, 39% borrowing, 32% of renting, roughly half are in mortgage stress and half are in rental stress on my modelling, 82% of houses. People ratio is just over 2 and a bit, so some families perhaps, 5.9% the vacancy rate, positive 4.1% gross investment yield, positive net investment yield, just. Average taxable 78,000 compared with 80,000, giving a disposal monthly, that's after tax of course, $5,600 with 32% going on the mortgage and 30% going on the rent. Scenarios are price rise is quite strong. Best case scenario for houses over the next 3 years. The base case, a small rise, and the worst case, a bit of a fall. And going back to the price moves, again, a bit of an interesting story here. Warree, 2016, the median price was 318,000. Not much happened until 2020 and 2021, where prices started to rise, and they've been rising very steadily. And last year were up about 14%. And you can see there that the median price is now $584,000. So compared with Melbourne, a very different story. Next one from Drift Fitness, 4127. And 4127, we'll put that in the model, is Daisy Hill, 4127. 4127. 10,000 households, 25% outright, 41% of borrowing, 33% of renting, a lot of mortgage stress, quite a lot of rental stress, 78% of houses, High people ratio, so again, it's going to be families. 5.2% vacancy rate. Gross investment yield, 4.4%. Net investment yield is just underwater. So for Queensland, that's quite interesting, actually. Unusual. $80,000 typical income, giving a disposal monthly around $5,600, with 36% going on the mortgage, just over $2,000, and 30%, $1,200 going on typical rent. And looking at the prices rises ahead, small rises over the next 3 years, best case scenario, bit of a fall otherwise. Okay. 41. Did I do the right one? Hang on, let me just check. 4127, yeah. I didn't actually run the modeling on that to look at the price moves, so I can't put your price moves in. Sorry about that. I missed it. Let me go to the next. Let me go to the next one anyway. Postcode 4122. Mr. Bingold. 4122. Where's that? 4122. Mount Gravatt East. And here you can see 18,000 households, 28% owning outright, 36% borrowing, 35% renting, 48% in mortgage stress, 79% in rental stress, and overall financial stress 50% here. 71% of houses, and you can see there the people ratio is, probably some families there. Vacancy rates around 5. Gross investment yields 4.4. Net investment yield underwater minus 0.1. Multi-flag is up, so we've got multiple incomes going on the mortgage, giving a disposal month around $6,800, with 34% going on the typical mortgage, $2,100, and 30% to $3,600, can't say it, 30%, $2,068 going on the typical rent. And if I look at the price moves in this particular postcode, you can see there that prices were in 2016 $589,000 on average. They went up in 2017, 2021, 2022, 23, 24, 25 to 1.24 million. Massive peak in 2021 at over 30%, again, thanks to that massive liquidity injection. Okay, Noah Scott asked for postcode 6280, which is West Bustleton in the Kalgoorlie district. And here we have 12,400 households, 36% owning outright, 37% borrowing, 25% renting. We have not a lot of mortgage stress, not a lot of rental stress, a bit, but not a lot. 89% of houses. We've got a bit of a lower people ratio, so probably some individuals as well as families. Quite high vacancy rates there too. Gross investment yields 4.1. Net investment yield is negative 0.7%. Average taxable 89,000 or 71,000, giving a disposal monthly of about $5,000, with 42% going typical mortgage, just over $2,000, and 35%, 1,745 going on the typical rent. Strong price growth expected in the best and base case scenario, a bit of a fall in the worst case scenario. And if I look at the scenarios ahead and look at price trends, well, they're looking pretty positive. This is actually the price trend information. 2016, it was 458,000 on average. There was a fall in 2018. Not much happened until 2021. But again, 2021, 22, massive liquidity increase. Massive rise in 2024, up 25%, and a further rise of close to 10% in 2025. So we've got $915,000, $915,000. So significant rise, nearly doubled over 10 years in this particular postcode. So that gives you a bit of a flavour of what we found from the questions that we were asked. And I will tell you that the story is quite variable based on where you look, what you look at. And as with all of these pictures, the message I want to leave with you is it's important to go granular. If you don't go granular, you will not actually understand the true dynamics in a particular location. And we saw in these examples the differences between some locations and others, with that massive spike in the liquidity injection period that we saw. And now, of course, the government's doing somewhat similar things, so it wouldn't be surprised to see further price rises ahead. Now, let's have a look and just look at the chat and see what we've got in terms of other requests for postcodes. And if we've got time, we'll cover a few of those. So let's see what we've got. Looking down the list, Steve, I think, was there with us. Postcode 6163. So let's put that in. This is Samson in Brand. I'm going to just take you off so you can see the whole thing. So this is Samson, 23,000 households, 32% owning outright, 39% of borrowing, 27% of renting, roughly half in mortgage stress, not much rental stress going on, 75% of houses, people ratios above 2, so probably some families there. Vacancy rate 8, which is on the higher end, 3.8% gross investment yield, positive 0.9% net investment yield, 93,000 versus 85,000 for the incomes, giving a disposal monthly around 5,200, with 41.5% going on the mortgage, 2,178 on average, and 33.2%, 1,745 going on the typical rent. Scenarios are that prices are likely to continue to rise. Best case scenario, 24% over 3 years. Base case, 9.8% over 3 years. And the worst case, a bit of a fall. Units following on. I can't put up the price information because I have to go and run a query, and I don't have time to do that on the live show. So I can only give you the other history in my information set here. One day I'll integrate the two, but there's too much programming to be done to do it, and I don't have time at the moment. Now, Drew asked for postcode 3337, which is Kurunjang. I think that's probably the way to say that. May not be perfect, but it'll be good enough. 14,600 households, 24% own outright, 48% of borrowing, 27% of renting. And you can see there that we've got mortgage stress at 38%, rental stress at 51%. We've got 91% of houses. We've got a 2.65 ratio for people, probably families there. Relatively low vacancy rate, 3.3% gross investment yield. Net investment yield is minus 1.3%. Again, I'll emphasize Victoria, Melbourne in particular, has a lot of negative returns on investment property at the moment. That's why I don't believe that investors are flocking in. 75,000, 76,000, so pretty uniform data there. We're giving a disposal monthly around 5,000 with 35.8% on the typical mortgage, 1,846, and 31.1%, 1,600 going on the typical rent. Scenarios, well, best case there may be a bit of a rise, 9.9%. Base case, a bit of a fall. Worst case, a more significant fall. So that's that one. Let's have a look. What else? I've got one here. Postcode 2200. This is Bankston. Okay. 15,600, 24 in only outright, 29 borrowing, 46% renting. Mortgage stress at 35% for the mortgages and 90% for the rentals. Overall stress at 62%. 38% are houses, 44% are units. The people ratio is quite high, so that includes some families. 8.8% is the vacancy rate. The growth rate's at 3.3%. Net investment yield minus 0.9%. Average taxable 71 to 72, depending on where you look at it. And that gives you a disposal monthly of around $5,000 with 48% go on the typical mortgage, 2,368, and 41.6% 2044 going on the typical rent. Price rises, well, 7%. Best case scenario over 3 years. Base case, a bit of a fall. Worst case, a more significant fall. And on it goes. Jazza Mac asks for 6530 Geraldton. Yeah. Put one up. Get rid of that so you can see it. So here, 13,000 households, 31% earning outright, 36% of borrowing, 31% of renting, 30% in mortgage stress, 42% in rental stress. And you can see there that 85% of houses, the people ratio is just over 2, 4% is the gross investment yield, minus 0.6 net investment yield, 89,000 versus 77,000 for the income. That's a disposal monthly around $5,400 with 33% going on the mortgage, 1820, or 23%, 1245 going on the typical rent. Scenarios are positive in terms of price growth in the best case scenario. In the best case scenario, worst case scenario, not so much. And yes, thank you. And please do give a thumbs up. Please like the show, like the post, and all of those good things. Cookie asked for 2281. We will do. Okay, this is Caves Beach in the Central Coast. And here we've got 6,500 households with 45% earning outright, a third borrowing, 21% renting, 34% in mortgage stress, 84% in rental stress, 81% of houses, people ratio is just over 2, vacancy rate is a little higher, probably some Airbnb and second homes there as well. Gross investment yield is around 3.5%, net investment yield minus 1.4%, average taxable income 90 compared with 72,000 from the census. Disposal monthly around 4,800 with 49%, $2,100 going on the mortgage and 38.3%, 1843 going on the typical rent. Scenarios are a bit of a rise, 11%, base case, a bit of a fall, worst case, a more significant fall. And so it goes on. A23 asks for 3033. Just Kilo East in Melbourne. 5,800 households, 46% earning outright, 34% borrowing, 18% renting, 34% in mortgage stress, 63% in rental stress, 80% of houses, 2.48, so a bit higher, so probably some families there, 6% the vacancy rate, 3.7% gross investment yield, minus 0.2% for net investment yield, 97 versus 99,000 for the taxable income, giving a disposal monthly around 6,400, with 40.2% or 2600, compared with 31.3% at 2023. And a bit of a scenario of a rise in the best case scenario, but the base and the worst case, a bit of a fall. Okay, so I think we're pretty much at the end of the queries, which is good. And let me just cut back to me. Cookie Boy asked about the ANZ job cuts. Yeah, we're going to see a lot more of this. And in fact, I made a show earlier on today, recorded it just before we went live with Robbie Barwick. And I'll put that show up afterwards. But we discussed there the Bendigo Bank fiasco with the continued closure of branches and the fact that politicians don't seem to want to do much about it. We also talked more broadly about the issue of bank job cuts and the fact that across the country, the banks are squeezing people out left, right, and centre. Of course, they're all arguing that it's to do with everybody migrating to digital. No. It's just an attempt to try and bolster their profits. Of course, they do get massive support from the government, yet the government doesn't want to actually do anything to intervene and to discuss how to save regional areas of Australia. And we're going to see more of this with AI. Of course, the AI revolution will revolutionize banking even more, and a lot of the people who are in the back offices will be out of their ear too. So more and more and more, we're going to see more job losses. This is not a good look. Bearing in mind, of course, we have massive profits from the banks at the moment. And it's interesting that they're still protecting their margins, because whilst mortgage rates have come down, if you look carefully, the interest rates on term deposits in particular, and call deposits even more so, have dropped more dramatically. So they're protecting their margins whilst growing their balance sheet. I showed you that money supply data earlier on. So they want you to hold your mortgage for longer, a bigger mortgage for longer, and keep paying and keep paying. And of course, that will improve their profitability. So that's the story. Jason, thank you very much. Thank you very much for your support there. It really is appreciated. And jump for joys. Throwing some doggy biscuits in. Thank you very much. I really appreciate that too. The dogs will love the doggy biscuits. Yes, they're still here, still sound asleep. So we'll make sure that they enjoy their doggy biscuits. It's a very important part. Okay. Interesting question here. Why would people put money in term deposits? Well, up until quite recently, term deposits were actually doing pretty well. You know, look at the interest rate compared with returns on investment property, doing a lot better in term deposits. Moved a little bit now, but shop around, you can still get some quite good returns. And that means that some people are doing okay. I think over time, the term deposit rates will continue to fall. I did actually make a show some time ago suggesting that we were pretty much towards the end of the term deposit hiatus. I actually have got a few term deposits in 5-year terms where I've got very nice rates with a locked in for quite a few years yet. So I feel quite chuffed about that. But anyway, I also appreciate all the support with the super chats. Cookie Boy says, we're rich tonight. Yeah, well, it all helps. There are huge costs involved in running all of this stuff, and so every dollar that I create out of this goes directly back in to supporting the shows and the equipment to make the shows. So nothing actually comes back into my own pocket. So just so we're clear. All right, well, we're coming towards the end of the show. I've just got a few more points to cover off as I do that. It's been a very interesting conversation this evening anyway, and I've certainly enjoyed it. Just to say that there is this conversation with Robbie that I made earlier on, and it is worth highlighting again that the banks are really not doing regional areas any great service. The fact of the matter is that the banks are actually looking after their own interests and the interests of their shareholders, never mind whether it's after the interests of ordinary Australians and businesses. That's a major problem. And the story is continuing to be a real issue. No real surprise. And in the show with Robbie, which I'll put up shortly, we did discuss this and the fact that regional communities are being let down. It is a major disaster. And we have to take action in the show that we'll be putting up shortly. We've made some suggestions about what to do. Of course, the critical thing to highlight is that the regional banking inquiry highlighted the possibility of a government-backed bank or a government-owned bank, and they recommended people should look at it. And what we're suggesting at the moment is that you should actually go ring your politician and say, oi, what about that recommendation from the regional banking inquiry, regional branch inquiry? What about initiating that analysis of whether a government-backed bank or government-owned bank makes sense, whether it's around Australia Post or not? That's all we're asking for. That work needs to be done, but it's just been put out to grass at the moment. So we are pushing for that at the moment. Thanks to you, Ben, for that comment. And Logan, yeah, thank you very much. And nice to see you in there. And thanks for the comments. Yeah, absolutely. We did. And watch the other show. You'll be, I think, surprised at just the way that the conversation went between Robbie and Bendigo. That's a bit of a teaser, but it was a very interesting conversation, and it just showed that what is going on is what you would not want to be going on. And of course, they're looking after their own interests, not the interests of the community. And just to remind you, banks are there at the gift of the Australian government. They support them massively, but they're there to help and facilitate commerce across Australia. Take the bank away and commerce disappears, which of course is the massive problem that we've got in so many parts of the country at the moment. Well, as I come towards the end of the show, I'll just want to make a couple of closing comments, because one of the things I try to highlight here is there are many households who are under significant financial pressure and doing it tough at the moment. And what I find quite often in online conversations is that people don't necessarily know where they are. So it's really important to look at a cash flow, build a cash flow, understand where the money is coming in, where it's going out. And from there, you can begin to plan accordingly. Don't just grab more debt. Don't just refinance and hope it'll go away. The conditions are such that we're going to see these negative conditions for quite some time. I highlighted earlier on, the incomes are likely not to grow in real terms for quite some time. If you are actually in financial difficulty, it is important to get the right help. I always remind people that the National Debt Helpline, 1-800-007-007, is a massive source of help. They are very busy, but this is a government-backed source of help. They can provide financial counselling. It is very important that you actually reach for the right people and just Google financial help, because you end up paying for help that you don't necessarily pay for. These people are much, much more reliable. Also, if you want to build a cash flow and need help, the AFCA Statement of Financial Positioning is actually a really powerful tool, and I recommend that. You can go and download it from the AFCA's Statement of Financial Position spot on their site. And Cookie Boy asks, do I think Auntie Michelle is going to hold for the rest of the year? Interesting question. Up until the other day, I felt she was likely to cut. The latest data and her last positioning over in Perth, I think it's a 50-50 call. I think it's quite likely that she won't be able to, simply because of the fact that, well, inflation is still bubbling away quite strongly. We'll see. Now, in terms of if you want more information about the work that I do, of course, you can go to my blog and sign up there. If you do that, you can get access to all the information that I provide. I also run my Patreon program. And on Patreon, there are different levels of support. Thank you for all those who support us via the Patreon program. It's really appreciated. And if you want to get the data that I shared with you this evening for a few postcodes, you can actually sign up for $50 a month plus GST and join. And I send out this information every month for those on the list. And that gives you information about 2,000 plus households across the country, updated every month with regards to stress and all the other information that we share. It doesn't include the price movements historically, because that's a separate database that I've not yet integrated. I will at some stage when I've got time. And also, just to say that if you want more information about Walk the World, there's a walktheworld.com.au channel. The blog is there. That's the link to the blog if you want that. And if you'd like to make a one-off support payment, you can also do it via PayPal, and that's the PayPal list there. Or indeed, we support Bitcoin as well if you're interested in making Bitcoin. Now, just to say that next week, Leith Van Onselen's back. And of course, Leith is the macro business guy, the guy who has been focusing specifically on migration. And Leith is back for another show next week, so that'll be fun. And just on that, he published this statistic, which just shows, it's a lovely chart that Tarek also reposted, showing the per capita GDP growth for all of the different recessions in the 70s, recessions in the 90s, the early 80s recession, the 2008 slowdown, and now you can spot the difference. We are going backwards. And that's really my closing thought. So there are many people who are up against it and who are really being caught up in this spin about property. And what I want to say is that there are clearly signs of property prices bubbling higher in some areas, not all areas. But it's very important that people are actually making good, considered decisions, get the right information, get the local information, make sure that you really understand what is going on. Don't just take those high-level spooks that are out there. Don't just be misled by the auction clearance rates, which, as I keep explaining, are on a miscalculation basis, but are still reported in all the media about hot. And just to remind you that not all parts of the country and not all types of property are going up. Some are going backwards. So it's really important to be careful. Make sure that you don't rely on the marketing spiel from the real estate agent or from the very inexpensive property report that was done as part of the marketing campaign. Get your own campaign too. And make sure that you make sensible decisions. I'm not saying don't buy. I'm just saying make sure that you do make good decisions, informed decisions. Don't get carried away. And particularly, as we see more people deciding not to go to auction because the auction is, well, probably not necessarily the best place to buy. Well, anyway, that's it. Thank you very much for spending some time with us this evening. The dogs are here, ready to go for the next walk. So that's my next task for the day. I want to say thank you very much for spending some time with us this evening. Thanks for all the comments, questions, and the super chats. Really appreciate them all. I'll look forward to seeing you next Tuesday on the live stream. Check out my show, which will be posted shortly with Robbie on the banks. I've also got a show tomorrow about gold, which I'm recording, which will come up shortly as well. There'll be some extra shows also about the government incentive programs for first-time buyers. So there's a lot happening on the channel. Check out the recorded shows. And meantime, I'll look forward to seeing you next week. This is Martin North from Digital Finance Atlantic signing off. Take care. See you soon.